All right, economics of Bitcoin. Do we agree with the cheat code naming convention, or is Peter just kind of out to lunch with this naming convention? Go ahead, take it away, Max.
Well, you know, Bitcoin, surely when you start using it, it feels too good to be true. It really feels like you do have a cheat code in life that just makes everything a bunch better. But I would argue Bitcoin isn't the cheat code. Bitcoin is how life should always have been, right? The cheat code is fiat money printing. That the fiat economy can simply be increased in money supply so that we allocate capital away from some people and towards others. That's a cheat code. If you print money, you get wealthier, while all the others who use the money get poorer. But with Bitcoin, nobody can print money anymore. And that means that the cheat code is finally gone. And what feels like a cheat code right now is actually just human life.
Anything to add? Are you guys good?
No, I don't want to follow that. No, I'll add something to lighten the mood a little bit, maybe. So some of you may have picked up on this now, but I've sort of stumbled into this inside joke with Peter where every time I go on What Bitcoin Did, it's now like my slogan that I don't even like Bitcoin, I just hate fiat, which I think nicely captures Max's point. But I think also is maybe going to be useful for some people in the audience that it's only partly a joke in that I have actually found that to be really useful in some cases of explaining, you know, why I do in fact like Bitcoin in the first place. That I think for a lot of people, actually probably for almost everybody, right, before they get sufficiently deep into Bitcoin, fiat is like water, right? It's like it just is the default that they have never thought of anything other than. And yeah, if you can, I really like this framing, Max, actually. You're going to have to rename the whole conference now. But yeah, if you can convince them that it's a cheat code, then actually Bitcoin just goes down a lot smoother. Because I completely agree, Bitcoin's just, it's without trying to make it seem less exciting, it's just normal. It's what should be the default, and it's fiat that needs explaining, not so much Bitcoin.
I think it's also like a matter of timelines. So for example, I fundamentally agree that Bitcoin is the anti-cheat code, as Max described. It's basically, it's a solution for the current system which has cheat codes built into it. But when you're in the earlier phase of the adoption cycle, if you understand something before other the consensus understands something, it can feel like a cheat code. And that's why I think it's on both sides of it. Right now, in practice, it does serve as a cheat code because companies that adopt it or people that adopt it or countries that adopt it get some disproportionate early benefits from doing so. That's why it feels like a cheat code. But yes, in the long arc of time, it's a much fairer system with no cheat codes built in. There's no one who gets disproportionate, lower cost access to the money than others, as we see with the fiat system. So I think it's a matter of two different time frames.
Lynn, we were down talking right before we came up here, and you were talking about Neil Kashkari and how he somewhat understands, I forget the quote that you said from a video you watched where he was talking about, like, in some areas, I guess Bitcoin makes sense, but for developed economies, it doesn't. And I said back to you, I said, well, I think from his vantage point, if I'm trying to just put myself in his position, is he just deeply believes that they're adding value by the flexibleness of the legacy system, that if the economy's down, they're able to add liquidity into the system and quote unquote save it, and they're able to pull it out if it gets too overheated. And they look at something like Bitcoin where nobody's controlling it, their hands are off, it's got a fixed supply, it's relentless in the fixed supply. So if you had the opportunity, anybody here on stage, to have that conversation with so many other people that I think have that same exact mindset of what Neil is describing there, like how do you bridge that conversation, and how do you bring it up that it is okay to take your hands off this thing that they are able to provide inputs and outputs to?
I think so. For quick context, Kashkari is a member of the U.S. Federal Reserve. Yeah, so that's the context there. And so he called Bitcoin beanie babies, which is funny because they were 15 years into the network. It's a over $1 trillion network. It has multiple valid use cases. But of course, if you're running the largest closed source centralized money in the world, you're not going to be very open to open source money in the same way. And so basically that's like Coca-Cola telling you that water's not as good as soda, for example. But in kind of hidden in his comment was ceding a lot of ground, because the talking point from central bankers used to be that Bitcoin has no use cases, or if it does have use cases, it's illegal use cases, it's drug traffickers, things like that. But his phrasing was, it has no use in an advanced democracy. So basically, he has ceded the ground to billions of people around the world that do not live in advanced economies. Now, I would argue, of course, that Bitcoin does have use in advanced economy, but even if you just take that framing and say, well, so you're saying it's useful to billions of people then, because that's where actually the majority of people live, in developing countries and countries that are not quote unquote advanced democracies. And I've generally found that when I talk to institutions or I talk to people that don't fully grasp kind of the use cases of Bitcoin, I generally have the most progress with them when I describe environments that have more broken monetary systems. If you're describing it to someone in the United States or in the UK or in most of Europe, money works fairly well for them, and so they don't really see the use case necessarily. The problems are more subtle. But if you list off a bunch of examples of people in developing countries with massive inflation or arbitrary bank freezes or all manner of things like that, that'll often click. They'll say, okay, I see why Bitcoin has a use case for those other people. And that, I think, is like the first step in, is basically saying, let's take a more extreme monetary environment or a more obvious set of problems, and let's see how permissionless, open source, non-debasable money can improve some of that. And then from there, you start working your way up. How could it be useful for an advanced economy? You can have that discussion. But I do think that it's interesting how the narrative is changing a little bit and kind of ceding ground to what is actually the majority of the world.
I want to be a little bit harsher than Lynn and say that people like Kashkari think that their money works well because fiat has so completely broken their brains as to what money actually is. So without launching into too much of a lecture or a rant here, I'll try to keep this concise. Maybe even reduce it to a slogan, right? Fiat money is a bank liability. There's not really much more about it you need to understand than that. Pretty much everything bad about it is downstream from that, with a few other kind of technical caveats about how this liability comes about. Bitcoin is actually money. And going back to actually the way Preston introduced it, this whole framing of, the flexibility of the money supply and the economy overheating, and I know you're just trying to quote him, so I'm not criticizing you, but I don't think any of that means anything at all. I think it's meaningful within the framework of somebody like Kashkari, who needs to insist that, dollars or euros or just fiat, and he probably wouldn't use the word fiat, but whichever fiat currency he's talking about is good money. But it's just all nonsense. That's really all I feel like I need to say about that.
And Bitcoin is money, and money is extremely useful. We know that because money is on half of every transaction, right? And we use it daily, numerous times, both to make payments and to get paid, and of course to hold the money in between those two. Right? So this is extremely, extremely important. And then the question is, well, what types of monies can there be? And as Alden said, there can be credit money, right? Where the token that you have is the obligation for someone else to give you something back. Right? For example, I have a paper certificate, a paper that says Allen will give me an ounce of gold coin as soon as I give him this paper back. Right? This is a claim. This paper is a claim on the gold itself. But of course, the paper itself is not the gold. So what is gold then? Right? If it's not a claim on something else, it is the thing, which makes it base money. It's not an obligation for someone else. It's not a liability of someone else. It is a stupid blind rock that just exists. And either you hold it or you don't hold it. And that makes Bitcoin extremely simple. We've never had a digital base money that did not exist before Bitcoin. Everything that we had digital, everything that was written on a piece of paper was the claim of someone else. Right? But to have truly something digital that is the thing in of itself and that nobody can take away from you or nobody can forgo the promise that was written on the piece of paper, that is an insanely groundbreaking achievement.
one of my favorite books was actually both of these authors over here. Allen's book, when he talks about GDP in your book, I'm telling you, I was just like sitting there, and as somebody that's studied finance and economics for all these years, I'm just like putting my hand in the air as I'm like reading this book. For people that aren't familiar, you hear GDP all the time, this term GDP, and it's like, well, what is GDP? And very simply, it's basically like the top line of a company, but at like a holistic country level for all the spending that's happening. But Allen in his book just goes on this rant, and I'm really hoping we can just capture that on stage right now as he describes GDP and the economics of GDP and how broke just thinking in terms of GDP is, especially in the face of what Bitcoin represents and what it's going to bring to the world. So I'm throwing it over to Allen to go on a rant and let this rip.
Again, I'll try to not have this rant go on for too long. Also remember what I said in the book that you liked so much because I wrote it a while ago. So GDP is essentially measuring consumption, which has, I wouldn't say has nothing to do with real wealth or real well-being, but once again, as with what I was criticizing with Kashkari, fiat economists, fiat advocates, whatever their position is, are very confused about what this is measuring and what even the underlying concepts, how they should be thinking about them. I think the most credit you could possibly give to whether it's GDP as a specific number or just the concept of consumption is that it is a downstream effect of success in capital accumulation. It is not itself the cause of anything good, right? You can only consume what you have in fact already produced. And so even as a starting point, if you're thinking, and this is purely conceptual, I'll get into my rant will be more about the actual details of it, but if you're thinking that you can measure wealth by consumption, you are already deeply, deeply confused. So to now dig in just a little bit deeper, again, I'll try to not go on for too long. GDP is basically measuring consumption in kind of an intangible sense. More tangibly, it's the aggregate of everybody's revenue, which is interesting to some extent because you make revenue as a company if you are serving some need in the marketplace. But revenue alone doesn't tell you anything about whether, first of all, you're serving it efficiently, and secondly, whether you're serving it in a sustainable way. So to tell whether you're serving it sufficiently, you need to look at profit, right? Because if you're serving a need but you're constantly making a loss, then you're just destroying resources. If you're making a profit, but nonetheless your return is still low, then you're still being inefficient just in a slightly different way with respect to the capital that you're deploying. So with all of this in mind, what you should really care about, both at a company level, by the way, but especially when you aggregate it up to the economy as a whole, is not revenue, it's not even profits, it's returns. And you can, I won't now, but you can get a lot deeper on, what the other ways it's bad to think in this way, but I think I'll round off the rant by just returning to the more intangible way of thinking about it. Like, where does this get you if you have this confusion? Basically, where it gets you is thinking that there is nothing wrong with, in particular, misallocating capital. In particular, not only is there nothing wrong with, there's actually something good about accumulating debt purely to boost revenue, because boosting revenue and boosting consumption, ultimately, you have decided is your goal. And actually, one point I'll end on, this is, I don't think I actually even say this in the book, but I think I mentioned it when we talked about it on your podcast, that to give an indication of just how deeply confused this is, how in the wrong direction you go, I don't think most people even really know this anymore. They just assume that GDP is somehow synonymous with the economy and, number go up is good in that respect, and that's how we should be measuring things. GDP was actually invented as a way to quantitatively determine how many resources could be extracted for the purpose of total war. You just let that sink in. Like, is that really how you want to measure your well-being? Like, how much of whatever you're doing can you stop doing and instead direct towards destruction? It really has nothing whatsoever to do with creation. It distorts every signal of any creation having been valuable And I think downstream of all of this is, is everything Max has already mentioned in terms of and Lynn too, I should say, the cheat codes of fiat, giving you all these shortcuts to just destroy things but enrich yourself. But just keep that in mind. If you're having an argument with somebody, say about, I don't know why you would end up in this position arguing about GDP, but if you really want to, remind them of this and just see what their reaction is. Because I would be willing to bet they don't even know. They probably think it's synonymous with wealth, when I would argue it's maybe even more synonymous with the ability to destroy wealth, not to create it.
I'm curious to Max and Lynn, if you guys have pet peeves like Allen here with GDP, when you hear a metric that you just roll your eyes and you're like, oh my God. And the reason why I ask the question is because I think there's so much terminology and there's things that we are just so accustomed to hearing all the time, and you just never question it. Like your point that you just made, Allen, with respect to it's really about the bottom line and not the top line if we were going to be trying to measure like real value to society. And the incentives of this system is pointing us to the opposite of this. It's consumption-based as opposed to value accretion. And so over to Lynn or Max, do you guys have any terms that kind of make you roll your eyes?
One thing I would point out to agree with the GDP issue is, like, especially when you look at capability for war and things like that, I often look at, or like, how big is the economy really when you're comparing, say, two countries and they each have a GDP assigned to them. Is this kind of like apples and apples, or is this kind of comparing two different things? And I remember, for example, this came up when say, war broke out in Europe, and they're saying Russia's this percentage of global GDP, for example, and it's comparable to this country. But it's like, if that GDP is very energy-based, that's a different type of GDP than another country's GDP. And so I generally find when I look at different countries, if I'm trying to measure their economic size, I look at energy production and energy consumption more so than I do GDP, or other tangible measurements of just overall capital accumulation. For example, population, number of skyscrapers, how much steel do they produce or consume? What does their industrial base look like? I generally find that those are more reliable measures of an economy than GDP. So I would agree with that point.
Yeah, and I think Bitcoiners say very often that, oh, look, I'm saving all of my Bitcoin. Look at how low my time preference is. Look at how far ahead in the future I think. And economically speaking, that's completely wrong. The opposite of correct. Saving money is a sign of high time preference. Right? So it means you're right now uncertain and don't exactly know what do you want to eat tomorrow, when, and how much exactly. There's this uncertainty, and for this you want to retain capital that is very liquid, because you don't know right now what you want tomorrow, but tomorrow you have something liquid that you can sell to whomever to really quickly get exactly what you want at that time. And so this means, holding money means you would prefer to not yet commit to finding out what you're going to eat tomorrow. Right? You're going to delay that decision one day later. And you do that by holding money. If you would actually have a high time preference, a low time preference, and you would think ahead in the future much longer, you would today spend your money, give it to someone else as a loan, earn the interest rate for one day, and get then the loan canceled when you actually are hungry. Right? So you pre-order the pizza, and the merchant will give you a little bit of a discount. And that little bit of a discount is the interest rate that you earn for being a capitalist, for investing your money, right, into goods and services. We can only produce after we have saved. So someone needs to first accumulate capital, but then if you sit on it, it just decays. Right? And even money can decay. There is a cost of holding and storing money. It's called demurrage. So you will need to invest your money if you want to keep up and keep the same purchasing power. And for this, well, you need to give it to someone else to be productive, to produce either with a credit or via equity. But ultimately, as soon as you're holding your money, you're basically saying every entrepreneur that what you're doing is not good enough. You could be much better in the entrepreneurial activity that you do. You could be much more profitable. So I'm not going to give you my Bitcoin right now, because I think if I hold on to them or give them to someone else, I will be better off. So saving Bitcoin, again, is a sign of high time preference. You're living here in this moment right now. And if you would want to increase your Bitcoin balance in the future, you should invest your Bitcoin today with funds like these guys here, so that they hopefully generate more Bitcoin for you in the future.
I did not pay Max to say that. Preston, can I just offer one other answer to your original question? Things I hate and I roll my eyes at.
Yeah.
Stimulate the economy. I can elaborate, but I just want to throw that out there.
When I'm thinking about the economics of Bitcoin, for me personally, the thing that just immediately goes right to the throat of it all is just a hurdle rate. So when I'm looking at investing, or I'm looking at spending and time preference and all these things, I'm just saying, okay, well, like, what's my hurdle rate, and like, what am I going to get on that versus that versus that? So over to Lynn, because hurdle rate might not be a term. I'm assuming most people are familiar with that term. If not, Lynn, if you can explain hurdle rate, like what it means from like a valuation standpoint, and then just your general broad thoughts right down the line for all the panelists on how you're thinking about economic calculation when dealing with the economics of Bitcoin.
Sure. So for the hurdle rate, if you're looking to invest, it's kind of like, what is the opportunity cost? What is the safer thing you could invest in? And what is the gap you're getting on a riskier investment? So in the current economic environment for decades now, for example, a 10-year government bond is kind of classically used as a hurdle rate. So if you can get, say, 4% when investing in a 10-year government bond of a developed market economy, that's your baseline. You wouldn't want to invest in something riskier with a lower expected return than that, because one is basically guaranteed by the government itself that can print its own money, so low default risk. And say, well, what would it take for me to invest in equities, right? So for example, you might say, I want an equity risk premium of at least 3%, meaning that if I can get 4% on government bonds, I only want to invest in equities that have more risk if I can get 7% or better. But of course, the kind of the structural inflation and money supply growth we have in the system distorts that, because really, when you're looking at a 4% return, you're actually often still getting diluted from the network. So for example, in the current monetary system, over the past, call it 50 years, the average money supply growth rate per year in an advanced economy is generally ranged between, say, 6 and 9%. Annualized. And so people often think that their hurdle rate is, let's say, CPI, so you're trying to keep up with the flawed measures of price increases going up. Then they say, okay, well, the treasury bond is usually somewhere around that level, maybe a little bit higher, sometimes lower, and they're looking to beat that. But really, I mean, I think that the hurdle rate you want to beat in the current system is the money supply growth rate. And I kind of measure that in terms of dilution or not. Is your share of the network getting smaller over time, or is it getting bigger over time, or is it staying the same? So if you hold dollars or you hold pounds and you are not earning an interest rate or some sort of cash flow return on that is exceeding or at least keeping up with the increase over time of that money supply, then your share of that money is decreasing compared to the overall network. You're getting gradually diluted out of the system. I think that's the real hurdle rate. And when you look at, for example, you can apply that to other monetary systems as well. If you're looking at gold, for example, gold's average supply growth is estimated to be something like 1.5% per year. It kind of ranges between 1 and 2%. And so you're as you hold gold, you're very gradually getting diluted as a share of the network. And so if you're measuring your performance in gold, you want to have it such that over time your gold stack from this investment or from this decision to do something with your gold is earning you more gold than the dilution that happens through gold mining, for example. And of course, with Bitcoin, the terminal growth rate of the supply is 0. And so basically, as you look out your hurdle rate is just 0 dilution. And so any sort of business that's built on Bitcoin or that earns Bitcoin or that is adding some value should basically earn something that is, you end up with more Bitcoin in the future. So it actually makes calculations more simple in the long arc of time. Right now it's challenging, of course, because Bitcoin's earlier in its adoption cycle. It's volatile. Most companies, their expenses are going to be denominated in fiat currencies in many cases. So they're managing multiple currencies in terms of both their revenues and their expenses. So it's a different environment right now for Bitcoin companies. But basically, I think that's a framework to think about. No matter what monetary system you're in, you want to look at the growth rate of that money. I think that's a better metric than what we see now, which is trying to beat the 10-year government bond or trying to beat CPI. I think those are almost like false targets. You give people these false targets, and they feel good that they beat that target. Like, look, you're earning higher interest on your government bond than CPI, so you're doing fine. That's it's almost like a false operation there. But I think that the key thing is to step back and always ask, are the activities that you're doing gonna result in you not getting diluted as part of the network? Or are you going to at least stay even? Are you going to grow your share of the network? That, I think, is the true hurdle rate.
I thought of an interesting comment on hurdle rates, actually, that links Lynn's answer with what Max said previously. So just quickly going back to Max's last comment. I don't mean to be putting words in your mouth, by the way, so please correct this if I then get it wrong. But everything Max said around time preference and saving and production and capital accumulation, first and foremost, tying all of them together, is true provided you have sound money. If you have fiat money, it goes completely haywire. And what I would argue that practically means, Max can maybe elaborate on this in a different direction, is that you just end up investing in all kinds of stupid bullshit that to start with will decrease the aggregate ability to create value, but actually if it goes on for long enough or if it gets bad enough, we'll just start directly destroying value instead. And thinking about the reason why, I think it's quite interesting, and it links to, in my mind at least, it links to hurdle rates. So, and in particular, Lynn's comments around, depending on what kind of investment you're trying to make, is it an interest rate or is it your expected return on an equity investment? Ultimately, real capital is scarce, right? Real resources are scarce. Time is scarce. Money ought to reflect that if it is going to accurately convey information that enables people to make these capital accumulation decisions. With fiat, obviously, it's not remotely scarce. There's a dramatic one way. You could think of it both of an excess in supply of monetary capital to be invested. I'd say that's maybe not quite technically right because it's also kind of fake. It's like it's not real. It's purely an excess of money because the money itself is as Lynn is pointing out is just growing exponentially. The value itself is effectively trending to zero on a long enough time horizon. And so with that excess of supply, the price to clear this market has to come down. And so the hurdle rates have to come down. What that actually means, though, because there is no real savings backing this, is basically just a lie that everybody has to believe, is that dumber and dumber things are going to get funded. And the competition for the real resources from what would otherwise be, are still legitimate businesses, but would otherwise be more compelling to invest in, purely because everybody's now chasing yield. Their hurdle rate has been completely distorted because they need to outpace inflation. They'll just invest in any old stupid bullshit. And Max's point, which should be true, it sounds good on paper, it just goes completely out the window and it becomes impossible to think about time preference properly.
Yeah, and to tie that into your earlier question of what makes me roll my eyes, inflation is a decrease in purchasing power, right? That's, if only inflation were only the decrease in purchasing power of money, right? That would be great. Inflation is so much more worse than that. It's almost unbelievable, right? So inflation is the increase of the money supply. Full stop. That's it. You have a base money, 100 units, you make it 150 units, that's inflation. Full stop. Very simple. So what are the consequences of inflation? Sure, the value of that token will go down, right? Because larger supply, same demand, means lower price. Obvious. But that's not the interesting part. The interesting is what happens to the entrepreneurial processes, to the production stages. And here, once those people who receive the newly created money first, they will think, hey, look, I got marginally more money. I'm rich, right? Where can I spend it on now? And they will spend it on the next best possible investment. Right? And cool, now they've invested the money there, so we print more money, and where are we going to invest that money next? Well, obviously, it has to be an investment that is marginally worse than the investment we just did earlier. Because if the second investment would be much better, well, we should have invested in it first. Right? So diminishing marginal returns. We first invest our money into the most valuable projects, and then the next best one, and the next best one, and so on. Which means the more money we print and the more we invest, the worse and worse and worse the quality of the investments will be. We will start producing shit that nobody needs and nobody wants because we think that we're all rich, right? Well, simultaneously, what happens when we print money is that on the consumption side, we all get a pay raise, great. Now, we don't even need to invest it in anything because look how well we're doing. We can just go party, right? Invite the family for a nice big dinner and go on vacation. That's going to be great. And here again, the more money we have, the worse and worse we consume it, right? First, we buy the thing that we really truly need, and then later the stuff that's kind of nice to have. So the more we print money, the more we overconsume, which means we decrease the available set of scarce resources. Right? Every steak that we eat is one that's no longer in the freezer to be eaten for later. So money printing leads to two causes, or two results. First, we increase the amount of investment into worse and worse products, and we increase the time of those production stages. Hayek would say we make those production stages more roundabout. And instead of a simple solution, we have the capital to go really long the way around. Meaning, we consume a lot of resources. We specify the resources to be less generic and more specific. While on the other side, we are over-consuming. Right? We eat and party all day long, again, further decreasing the resources that we have, thinking that, hey, look, in the future, we'll have plenty of resources, that's fine. But now the worst part of inflation is that both of these two things happen at the same time. So we overproduce our resources and we overconsume our resources. And this is great, right? We're all thinking we're rich at this moment. That's the boom period of the business cycle. The problem is when you start realizing that, oh, I thought that I can, finish the building that I just started because we were all so rich, we had so many resources all of a sudden. But no, all other entrepreneurs were building as well, and consumers were taking away the resources on other places. So now we don't have any resources available to finalize the investments and the projects that we started. Meaning a bust, half-finished houses, right? Shops having to close down. That's economic depression. And the fundamental reason for this is because we started printing money. The great thing is, that means we have the easiest solution to prosperity and human flourishing. Just stop printing the money. Stop stealing from each other, and we will be filthy rich, all of us.
I know Bitcoin has just drastically changed how I personally look at money and what I'm willing to spend it on. I drive a truck, 2017 truck, and I just have no desire to get a new truck because I'm just looking at this hurdle rate of Bitcoin. I'm saying, yeah, I'm not willing to go out and buy a $80,000 truck and get something. This one over here is just working perfectly fine. And I'm constantly running those numbers. And I'm just curious, in the audience, raise of hands, has everybody else felt something like this where you see the way you interact with your purchases and what? Yeah,
this is why we're winning.
Yeah. Okay, so on an individual level, we can personally see how this is impacting our lives. You get to the corporate level, I would imagine, MicroStrategy is a perfect example of a company that's performing this economic calculation, and they're making decisions to store and retain in Bitcoin. Where it gets challenging, and we have 3 minutes to cover this, at the sovereign level, how does that play out in your mind where at the sovereign level, they're starting to figure it out? We saw El Salvador as an example on a micro scale, but how about more advanced economies, G7s? How is that actually going to manifest itself where they understand this deep value prop that's manifesting itself?
I'll touch on it. Basically, I think it's slowly going up the stack. Basically, a big chunk of how finance works for the past several decades is you have a depreciating unit of account because the supply is going up. And if you're in a position where you can short it, meaning borrow it for a long period of time at a low interest rate, that has been, unfortunately, a very successful way to build wealth. It's kind of like playing blackjack with the economy. You want to have a lot of debt, but not so much debt that you blow up in a recession. And that's kind of how we've allocated resources. That's who's benefited most from the system. And I think during a transition, that unfortunately continues to be true for a period of time. So, for example, MicroStrategy, they use the fact that they have access to very cheap fiat capital markets, and they can issue, they can issue debt, they can issue convertible instruments, they can issue equity, and then they can use it to buy Bitcoin. It's kind of surprising we haven't really seen it on the sovereign level yet. They can print something that can endlessly increase in supply, and they can buy something with absolute scarcity. And so far, at least on the kind of the public stage, there's not really been much of that. I think once that kicks off, it gets interesting because there's 200-ish countries in the world. Something like 160 of them have their own currency, and they can issue the currency to buy Bitcoin. And if you're first at doing that, you get disproportionate benefits from if you're the 100th country to start doing that. And we're seeing it in the corporate sector. I do think the sovereign level's next. It probably starts with someone smaller. There's already, for example, there are countries mining Bitcoin now. There are countries holding it as a reserve asset, generally a smaller countries, not a lot of them, usually a smaller share, but it is happening around the margins. I think it gets interesting when one of them just says, look, we're just going to create more of this thing that we can do infinitely and buy something scarce with it. And I think it's like most things in Bitcoin, that can be disruptive when that happens, but that's a phase it has to go through.
It almost seems like they especially advanced economies have to be doing it in some type of secretive way, because if they were open and public about it, that you would just crush the treasury markets as soon as that type of announcement would be made. Do you think that's happening today? And if you don't, do you think that they do need to do it in some type of secretive way, and that's how it would be rolled out? And I know we got 30 seconds. Just yes or no.
Oh, that's a super simple answer. Yes, it's absolutely happening today.
You think it's happening right now, Alan? Okay. Max, 24 seconds.
In order to make it happen even faster, I'll give you 5 books that are all about economics instead of answering your actual question. So Theory and History by Ludwig von Mises and Economic Science and the Austrian Method by Hans Hermann Hoppe are 2 fundamental books on the theory of economics, right? Then how to think like an economist, kind of. Then we have Man, Economy and State by Murray Rothbard. This is the end result of thinking like an economist. Then we have by Jörg Hülsmann, The Ethics of Money Production. Thinking like an economist about money and what it actually means. And then finally, the most recent book, Crypto Economics on the Fundamental Principles of Bitcoin by Eric Voskuil. This is the most insanely accurate and logically consistent book about the economics of Bitcoin. Please read it. You will learn much more than all of us 5 here could convey you in 40 minutes.
All right. The economics of Bitcoin.
Thank you.
Thank you very much.
Thank you.